Very good day, friends. In this video, we are going to pick up the summary, fast track or refresher of chapter 3, which deals with the topic of residential status and scope of total income. So we will cover the concept of residential status and then the concept of scope of total income. So let's pick up residential status first. What is the need of residential status? Why to determine residential status? So as we have noted, income tax is charged on the total income. What is total income? Total income means the total amount of income referred under Section 5. Section 5 deals with the scope of total income and which is computed in the manner laid down in the Act. Section 5 outlines the scope of total income. That means what is within the scope and what is outside the scope. And this depends on the residential status of a person. And the residential status is in turn determined under Section 6. Right? So Section 6 is the relevant section for residential status. Section 5 is for the scope of total income. Now the residential status of a person can be that of a resident or a non-resident. So if you look at this chart, the residential status for an individual in HUF can be that of a resident or a non-resident. Okay. Further, a resident can be classified as a resident and ordinarily resident ROR or a resident but not ordinarily resident RNOR. So in the case of individual or HUF, a resident can be further classified as ROR or RNOR, and the individual or HUF can also be a non-resident. A firm, AOP, BOI, company or any other person, that means all the persons except individual or HUF can be classified as a resident or a non-resident. The concept of ROR and RNOR is not applicable to a person who is not an individual or HUF. Now the residential status is determined for each previous year for a person. Okay. It's not the same across all previous years. You cannot say that for a previous year, if I determine the residential status, it will apply the same for all subsequent years also. No, it can be different for different previous years. So it's determined for each previous year and it is same for all sources of income because residential status doesn't apply to a source of income but to a person. Now we will first revise the provisions regarding residential status of an individual and then we will move on to other categories of persons. Rules to determine residential status of an individual can be categorized into A. Special rules, B. General rules, and C. Stateless rule. So there are three categories of rules: special rules, general rules, and stateless rules. Right? First, we will see when can an individual become a resident under these rules. Right? When can an individual become a resident under a special rule or a general rule or a stateless rule? Right? First, we will look at that. Thereafter, we will check the steps to determine the final residential status as to whether the status will be that of a resident or a non-resident. Right? So first, we will look at these rules: A, B, C, special rules, general rules, and stateless rule, and we will see whether an individual can become a resident under these rules. Finally, we will look at the steps to determine the residential status, whether finally the residential status can be said to be that of a resident or a non-resident. So first we will learn about the rules and then about the steps to follow to determine the final residential status. So we'll first take a look at the special rules. There are 4 special rules targeting specific categories of individuals. Right? 4 special rules. The individual becomes a resident in India if he is in India for at least the specified number of days. So a threshold has been prescribed for these rules. Once a resident, he can be classified further either as a ROR or RNOR, depending on his historical residential status or presence in India. And these rules are depicted in the chart. So we'll now look at the chart. What are these 4 rules? Ship crew rule, employment rule, visit rule, and visit and income rule. These are the 4 rules. Okay. These are the criteria to be satisfied for a person to fall under a particular rule. Then we have basic stay condition which have been stipulated for each of these rules to determine whether the person will be a resident. Once a resident, then we need to check the secondary stay conditions to determine whether the status will be of a ROR or RNOR. Now, ship crew rule. Ship crew rule applies to a citizen of India. It applies to a citizen of India who leaves India in the previous year as a member of the crew of an Indian ship. So the person should be a citizen of India. He should leave India in the previous year, and he should leave India as a member of the crew, not as a passenger, as a member of the crew of an Indian ship, not a foreign ship, right? If this criteria is satisfied, then the basic stay condition says that if such person is in India for 182 days or more in the previous year, okay, so basically we are saying that the person should be in India for at least half of the year. So if the person is in India for 182 days or more in the previous year, then the person is treated as a resident. The second rule is employment rule. Just like ship crew rule, employment rules also applies to a citizen of India. But in this case, the citizen of India should leave India in the previous year for the purposes of employment outside India. So the person should be a citizen of India. He should leave India in the previous year for the purposes of employment outside India. If that be the case, then the basic stay condition is the same as for ship crew rule. That means if such person is in India for 182 days or more in the previous year, he becomes a resident. The third rule is the visit rule, and the fourth rule is the visit and income rule. Both the third and the fourth rules apply not only to a citizen of India but also to person of Indian origin, right? So this is an addition. Ship crew rule and employment rule apply to a citizen of India, but visit rule and visit and income rules apply also to a person of Indian origin. So the person who is a citizen of India or a person of Indian origin who comes on a visit to India, so ship crew rule and employment rule apply where the person is leaving India, while the visit rule and visit and income rule apply while the person is coming on a visit to India, right? So in these situations, the visit rule and visit and income rule applies. Now what we need to check is what is the total income which is other than income from foreign sources of such person, right? So once we have noted that a person is a citizen of India or a PIO who comes on a visit to India in the previous year, then we need to check what is the amount of total income other than income from foreign sources. If such total income other than income from foreign sources is less than or equal to 15 lakh in the previous year, that means it doesn't exceed 15 lakh, then the visit rule applies. And if such total income other than income from foreign sources is greater than 15 lakh in the previous year, then visit and income rule applies. Where visit rule applies, then the basic stay condition is the same as that for special rule number 1 and 2. That means if such person is in India for 182 days or more in the previous year, he becomes a resident. For visit and income rule, that means where the total income other than income from foreign sources is on the higher side, it's greater than 15 lakh, then a lower threshold has been prescribed, lower than 182 days. And two conditions need to be satisfied. The first is that the person is in India for 120 days or more, or lower threshold, right? 120 days or more in the previous year. And the second condition is he should be in India for 365 days or more in the preceding 4 years, right? So the stay in India, the presence in India in the preceding 4 years should be at least 365 days, and in the current year it should be at least 122, it should be at least 120 days. If both these conditions are satisfied, then the person becomes a resident under the visit and income rule. Okay. So these are the basic stay conditions for a person to become a resident under these special rules. Now, once a person becomes a resident under a special rule, then it needs to be further checked whether the person can be classified as a ROR or a RNOR, and for that we need to check the secondary stay conditions, right? There are two things that we need to check. Whether the person is a non-resident, that means not a resident. Whether a person is a non-resident in 9 out of 10 preceding financial years, right? Whether the person is a non-resident in 9 out of 10 preceding financial years. Second is whether the person is in India for less than or equal to 729 days in the preceding 7 previous years, right? So in point number 1, 9 out of 10 preceding previous years is the relevant duration. In the second point, preceding 7 previous years is the relevant duration. So if any of the above conditions is satisfied, that means either one or two or both, then the person becomes a RNOR, that means resident but not ordinarily resident. So if the person is a non-resident in 9 out of 10 preceding previous years, and is in India for less than or equal to 729 days in the preceding 7 years, that means we can say that his connection or nexus with India is weak, and therefore he is treated as a not ordinarily resident RNOR. Else he is treated as a ROR, that means resident and ordinarily resident. That means when none of the above conditions is satisfied, neither 1 is satisfied, neither 2 is satisfied, then a person becomes ROR. And if any or both of the above conditions are satisfied, then the person becomes RNOR. However, this classification of a resident as ROR and RNOR is applicable to ship crew rule, employment rule, and visit rule. It is not applicable in the fourth special rule, that is visit and income rule. For visit and income rule, the concept of ROR doesn't apply, right? If the person becomes a resident under the visit and income rule, then we need to check whether the person is in India for less than 182 days. If the person is in India for less than 182 days, then the person automatically becomes a RNOR. So the concept of ROR is not relevant when a person is becoming a resident under the visit and income rule. So if you look at the visit and income rule, the condition was that the total income other than income from foreign sources should be greater than 15 lakh in the previous year. And then for becoming a resident, two conditions needs to be satisfied. That means should be in India for at least 120 days in the previous year and in India for at least 365 days in the preceding 4 previous years. If that is the case, then we need to see whether the stay in India in the current previous year is less than 182 days. If yes, then the person becomes a resident and a RNOR. If the stay in India for the current previous year is 182 days or more, then visit and income rule becomes irrelevant. Then we move to a general rule, which is the 182-day rule, which we will talk in some time. In terms of steps to follow, you should apply the following sequence to determine whether an individual is a resident. Firstly, we need to check whether he satisfies the criteria to get covered under a special rule. So what is the criteria? The criteria is this criteria. If the person satisfies the criteria, then we need to check whether the person becomes a resident under the special rule, right? And then the second step comes in that we need to check whether he satisfies the basic stay conditions specified under that rule to become a resident. If he satisfied, then he becomes a resident under that special rule. So as we noted, these are the basic stay conditions. That means the threshold of 182 days for special rules number 1, 2 and 3, and for visit and income rule, there are twin basic stay conditions that needs to be checked. And if these are satisfied, then the person becomes a resident under a special rule. As per step 3, we need to move to the next check where we need to determine whether he satisfies the secondary stay conditions, right? These are the secondary stay conditions. If he satisfies any of the secondary stay conditions, that means secondary stay conditions 1 and 2, he is a RNOR. And if he satisfies none of these conditions, he is a ROR. As we discussed above, secondary stay conditions need not be checked if the individual becomes a resident under the visit and income rule. In such case, he becomes a RNOR if he is in India for less than 182 days in the previous year. This is what we discussed. He becomes a RNOR. Thus, the treatment is different in case of visit and income rule. Okay. If, however, such individual who is falling under the visit and income rule is in India for 182 days or more in the previous year, the 182-day rule becomes applicable to him instead. And he then becomes a resident, and further he gets classified as either a ROR or RROR under the 182-day rule. Now we noted above that the visit rule and visit and income rule applies to a person of Indian origin as well. Applies to a PIO as well. Who is a person of Indian origin or a PIO? PIO means an individual if he or any of his parents or grandparents was born in undivided India, not in the present day India, in undivided India, that is India before partition. So if he or any of his parents or grandparents was born in undivided India, the person would be treated as a PIO, and consequently the visit rule and visit and income rule can be applied to him. What is rule 126? What is rule 126? So just to note, in the ship crew rule, we saw that it applies to a citizen of India who leaves India in the previous year as a member of the crew of an Indian ship. Crew of an Indian ship. Okay. Now, as per the general rule, while computing the period of stay in India, the date of arrival in India or departure from India is included. However, there is an exception which is provided in Rule 126. Note the exception. In case of a citizen of India and a member of the crew of a foreign bound ship, okay, it need not necessarily be in Indian ship. It can be a foreign ship, it can be an Indian ship, but it is a foreign bound ship. That means the origin of the voyage is in India and the destination is in a foreign country. So it becomes a foreign bound ship. So if a citizen of India is a member of the crew of a foreign bound ship leaving India, then the period which is specified in Rule 126, it is not included while determining the stay in India. It is excluded. And what is that period? It is the period which is entered into the Continuous Discharge Certificate, CDC. And this period begins from the date entered in respect of joining the ship and the date entered in the CDC in respect of signing off from the ship. So both the dates in respect of joining the ship and signing off from the ship are not to be included. So from the date of joining to the date of signing off, the entire period is excluded while computing the period of stay in India. Right? So this is Rule 126. If Rule 126 is not applicable, then the general criteria applies, as per which the date of arrival in India and date of departure from India is not excluded, but it is included while determining the period of stay in India. However, if Rule 126 applies, then both these dates, we will note, are not to be included. So this is the benefit which is provided. What is the meaning of employment? So as we noted above, employment rule applies to a citizen of India who leaves India in the previous year for the purposes of employment outside India. Now, what is the meaning of employment? Does it mean only employment with an employer on salary? So we need to note that the individual should leave India for the purposes of employment outside India. It does not mean that the individual leaving India should be unemployed, right? He can be employed in India and he is now going abroad for, say, another employment. Further, employed not only means salaried employment but also self-employment for business or professional work. Income from foreign sources. What does it mean? So we have noted in the context of visit rule and visit and income rule that we need to check the quantum of total income other than income from foreign sources, whether it's more than 15 lakh or up to 15 lakh. If it is up to 15 lakh, then visit rule applies. If it is more than 15 lakh, then visit and income rule applies. So what is important is to figure out the quantum of total income, but which is other than income from foreign sources. So therefore, we need to understand what is the meaning of income from foreign sources. So income from foreign sources means income which accrues or arises outside India and which is not deemed to accrue or arise in India. We will see later on that an income can accrue or arise in India or accrue or arise outside India, right? So income which accrues or arises outside India is income from foreign sources. However, as per section 9, even if the income accrues or arises outside India, in certain cases it is deemed, though it's not actually accrued or arisen in India, but it is deemed to have accrued or arisen in India. So even those cases, the income is considered as income from Indian sources, which is deemed to accrue or arise in India. So that means both the things should be satisfied. Income should accrue or arise outside India and it should not be deemed to accrue or arise in India. Then it will be actually be treated as income from foreign sources. However, there is one exception. Even if the income accrues or arises outside India, even then it will not be treated as income from foreign sources, in which case, where the income is derived from a business controlled in or a profession set up in India. If the business is controlled in India or if the profession is set up in India, there is a good amount of nexus or connection with India, and therefore even if the income from such business or profession accrues or arises outside India, even then it will not be treated as income from foreign sources. Okay, so income from foreign sources means income which accrues or arises outside India and which is not deemed to accrue or arise in India. However, the income derived from a business controlled in India or a profession set up in India is considered as income from Indian sources, not income from foreign sources. Therefore, total income, which is other than income from foreign sources, can also be referred as total income from Indian sources. And this is the total income computed after excluding income from foreign sources. What is income from foreign sources? We just now discussed. Now, exempt income is not to be considered. If the question lists down an income which is exempt under the provisions of the Act, then it will not form part of the total income other than income from foreign sources, because total income refers to taxable income. Exempt income doesn't enter into the scope of the total income in the first place. We will now look at the general rules and see when does an individual become a resident under a general rule. So general rules apply if the individual does not fall within any of the special rules given above. So we noted the 4 special rules. First, we need to check the special rules, and if the individual doesn't fall under any of the special rules, then we need to move on and check whether the individual falls under a general rule. There are 2 general rules, 182-day rule and the 60-day rule. And these rules are applicable to all individuals and specify the general criteria to become a resident in India. And there is a threshold. So if the individual is in India for at least the specified number of days, he becomes a resident. Once a resident, he can be classified as a ROR or RNOR, depending on his historical residential status or presence in India. Let's see what are the general rules. So there are two general rules, 182-day rule and the 60-day rule. And just like we saw in the special rules, there are basic stay conditions to determine whether a person will be a resident. Once a resident, then we need to check the secondary stay conditions to determine the classification as ROR or RNOR. Under the 182-day rule, the threshold is 182 days. That means if the person is in India for 182 days or more in the previous year, the person becomes a resident. So this basic stay condition is the same as that for special rules which we discussed above, except the visit and income rule. Right? So it's the same. The threshold is 182 days. Then the person becomes a resident. Once a resident, then we need to check the secondary stay conditions, and if any of the secondary stay conditions are satisfied or both these conditions are satisfied, then the classification is that of RNOR. If none of the conditions are satisfied, then the classification is that of ROR. And the secondary stay conditions are same as that we noted for the special rules, so we are not going to discuss them again. They are exactly the same. Okay, so this is the first general rule, which is the 182-day rule. The second general rule is the 60-day rule, as per which instead of the threshold of 182 days, a lower threshold of 60 days is provided. So there are two conditions to be satisfied in terms of the basic stay conditions. First, the person is in India for 60 days or more in the previous year, and second condition, the person is in India for 365 days or more in the preceding 4 previous years. So both these conditions need to be satisfied, and if that be the case, then the person becomes a resident. And again, classification is done of ROR or RNOR depending on the satisfaction of secondary stay conditions. So what is the sequence that we need to apply to determine whether an individual is a resident and further a ROR or RNOR under a general rule? Number one, check whether the person satisfied the basic stay conditions as specified. Okay, that means the threshold of 182 days for a 182-day rule and twin conditions of 60 days in the current previous year and at least 365 days in the preceding 4 years for 60-day rule. If these basic conditions are satisfied, then the person becomes a resident under that general rule. Secondly, we need to check whether he satisfies the secondary stay conditions. If he satisfies any of the secondary stay conditions or both of them, he is a RNOR, and if he satisfied none of these conditions, he is a ROR. So these are the general rules. And general rules, as we noted, are applicable to all individuals, whether a citizen of India or a person of Indian origin or any other individual, including a foreign national. It doesn't matter. An individual who is in India for 182 days or more in the previous year would become a resident under the 182-day rule, right, as per the basic conditions. And one need not check the 60-day rule because that becomes irrelevant in such case. If, however, the person is in India for less than 182 days and consequently he is not a resident under the general 182-day rule, then we should check whether he can become a resident under the 60-day rule. If he also doesn't become a resident under the 60-day rule, then we can say that the individual is not a resident under a general rule. Now we will look at the third category, which is the stateless rule. Now the stateless rule seeks to deem a person as a resident in India. It deems a person as a resident in India if certain conditions are fulfilled, even though the person is not a resident under any of the special or general rules which we discussed. Okay, so a person can be a resident under a special rule, in which case we need not check the general rule and the stateless rule. A person may not be a resident under the special rule but may be a resident under the general rule. But there can be a situation where a person is not a resident under any of the special rules or any of the general rules, in which case we need to fall back on the stateless rule and check whether the conditions are satisfied. If yes, then a person will be deemed to be a resident even though the person is not actually a resident under those rules. And such person is treated as a RNOR. What are the conditions to be fulfilled? Individual is a citizen of India having total income other than income from foreign sources. This is the concept that we have already discussed in the context of special rules, the visit rule and visit and income rule. Total income other than income from foreign sources is greater than 15 lakh in the previous year, greater than 15 lakh. And he is not liable to tax in any other country or territory by reason of his domicile, residence, or any other criteria of similar nature. So a person who is a citizen of India and he has a total income other than income from foreign sources which is greater than 15 lakh in the previous year, and he is not liable to tax in any other country or territory, then he is deemed to be a resident and he is classified as a RNOR, not a ROR but a RNOR. What is the meaning of liable to tax? A person is liable to tax in a country if there is an income tax liability on such person under the law of that country. So if under the laws of the country there is an income tax liability on the person, then the person is said to be liable to tax, and consequently the person cannot be deemed to be a resident under the stateless rule. A stateless rule applies where the person is not liable to tax in any other country or territory. What happens where a person has been subsequently exempted from such liability under the law of that country, right? So the person is liable to tax, but he has been exempted, so he is not required to pay any tax. In such case, the person is liable to tax because though there is an income tax liability, but the person has been exempted from such liability. It doesn't mean that the person is not liable to tax. It means even in such case that the person is liable to tax, and therefore stateless rules won't apply in such case. So what is the sequence to be followed under the stateless rule? Number one, check whether the person is a resident under any of the special or general rules, right? If no, if the person is not a resident, then we need to come to the stateless rule and check whether he satisfies the conditions of getting covered under the stateless rule. If he satisfies, he is deemed to be a resident and is treated as a RNOR. Stateless rule basically overrides other rules. What does this mean? If a person is not a resident under any of the other rules, special or general rules, he can still become a deemed resident under the stateless rule. However, if a person is already a resident under a special rule or a general rule, the stateless rule does not apply and it need not be checked because there is no need. A deemed resident under a stateless rule is always a RNOR, cannot be a ROR. However, if a person becomes a resident under a special rule or a general rule, then we have already noted that the person can be a ROR or a RNOR as well under those rules. You should note that the period of stay in India is not relevant under the stateless rule. There is no condition regarding the period of stay in India. So even if the person is not at all in India during the previous year, even then he can become a deemed resident under the stateless rule and consequently a RNOR. A stateless rule applies only to a citizen of India, and you should note that it does not apply to a person of Indian origin who is not a citizen of India, right? Because the stateless rule applies only to a citizen of India. Certain points which are common to all the rules. The dates of arrival in India and departure from India are to be included in the period of stay in India. However, we have also noted the provisions of Rule 126, which give a kind of relaxation as per which the date of joining and signing off are not to be included. If Rule 126 is not applicable, then date of arrival in India and departure from India are to be included in computing the period of stay in India. And what is India? India is defined under section 2, and this is something that we have noted in the first video on the topic of basic concepts. Stay in India need not be continuous stay, right? The person can come and go and all those periods need to be aggregated. It need not be non-stop or continuous. Further, stay can be anywhere in India. It doesn't mean that the stay should be only at one location throughout. Right? And stay in India is not merely restricted to land because the definition of India is wide enough to include its airspace, as well as its territorial waters. All these points in gray are basically tax traps to avoid common mistakes. Some of them we have already discussed, and since this is a fast track video, we are not going to discuss these tax traps. We are only going to discuss the key points of the provision. So now, having discussed the special rules, general rules, and stateless rules, we have now seen when can a person be treated as a resident and consequently a ROR or RNOR under those rules. Now we will look at the steps to follow to determine the residential status of a person. And this is a chart. This is a flow chart which will give you a clear idea of what are the steps to follow. So first of all, we need to check whether a special rule applies or not. That means whether a person satisfies the criteria of falling within the special rule, ship crew rule or employment rule or visit rule or visit and income rule. If yes, then we need to check the stay conditions, the basic stay conditions and the secondary stay conditions. If those conditions are satisfied, then the person would become a resident under a special rule, and further ROR or RNOR. However, we have noted that if the person becomes a resident under the visit and income rule, the person can only be a RNOR, not a ROR. If the person is satisfying the criteria of falling within a special rule, but the stay conditions are not met, then we need to move to the stateless rule and check its applicability. If it's applicable, then the person is deemed resident and classified as RNOR, else the residential status of a person is that of a non-resident. Okay. So we need to check whether a special rule criteria is met or not, and then the stay conditions therein are met or not. If yes, then the classification is that of a resident or ROR, RNOR. If the person is falling in a special rule but the stay conditions are not met, then we need to move to the stateless rule. And then finally decide whether the person will be either a deemed resident, RNOR under a stateless rule, or a non-resident. If the person doesn't fall within the special rule in the first place, that means if he fails to satisfy the criteria of falling in a special rule, then we move and check whether the general rule applies, right? In that case, we check whether the stay conditions under the 182-day rule or the 60-day rule are met. If yes, then the person is classified as a resident and further a ROR or RNOR. If the stay conditions are not met, then we move and check whether the stateless rule applies. If yes, then the person becomes a deemed resident, RNOR, else the person becomes a non-resident. So you will note that general rules do not apply whereas special rule applies, right? So first we need to check the special rule. If the special rule doesn't apply in the first place, then only we need to go to the general rule. So if a special rule applies, that means a person is fulfilling the criteria of falling within a special rule, but the individual does not become a resident under a special rule due to non-fulfillment of its stay conditions, then we cannot resort to a general rule, and therefore the person cannot be treated as a resident by resorting to a general rule, right? In that case, we will straight away move to the stateless rule. But if the special rule doesn't apply in the first place, then we need to go to the general rule, and if general rule stay conditions are not met, then we need to check stateless rule. For example, if employment rule applies and the threshold is 182 days and the person is less than 182 days, therefore the person is not becoming a resident under the employment rule, right? It doesn't mean that now we can move and check whether the person is becoming a resident under the general rule of 60-day rule, right? Because the person is not becoming a resident under the employment rule, though he is falling under that rule, right? In that case, we will not move to the general rule. We will then check lastly whether the stateless rule applies or not, and accordingly determine the residential status of that person. And now we will move to determine the residential status of a HUF. So an HUF can be a resident or a non-resident, and further, if the HUF is a resident, then it can be classified as a ROR or RNOR. Now, what is the rule to determine the residential status of an HUF? It needs to be seen whether the control and management of its affairs. Where is it situated? If the control and management of its affairs is situated wholly outside India, wholly outside, then the HUF is a non-resident. Else, that means where the control and management is either wholly or partly situated in India, then the HUF is a resident. Once a HUF becomes a resident, then the HUF can be either a ROR or RNOR, and then we need to check the secondary stay conditions, which are the same as that we have discussed in the context of an individual. But those conditions need not to be checked in the context of HUF, but in the context of its Karta. So the Karta is non-resident in 9 out of 10 preceding previous years, or the Karta is in India for at least 729 days in the preceding 7 previous years. If any of these conditions is satisfied, then the HUF becomes a RNOR, else the HUF becomes ROR. That means if none of these conditions is satisfied, then the HUF is classified as ROR. Okay. Control and management refers to the actual control and management. It doesn't basically refer to the place where the day-to-day work or the routine work is being carried out. It refers to the actual control and management. So this is how we determine the residential status of an HUF. What about the residential status of firm, AOP, BOI, local authority and artificial juridical person? We again need to check where is the control and management of the affair situated. If it is situated wholly outside India, then the residential status is that of a non-resident. Else, that means when the control and management is wholly or partly in India, the residential status is that of a resident. And except for individual and HUF, the concept of ROR and RNOR is not applicable. So in this case, the person can either be a resident or a non-resident. Residential status of a company. We need to figure out whether the company is an Indian company or a foreign company. If the company is an Indian company, in all the cases, the company is treated as a resident in India. However, if the company is a foreign company, then if certain conditions are satisfied, then the foreign company is treated as a resident. Otherwise, it is treated as a non-resident. The condition for becoming a resident is that its place of effective management, that its POEM in that year, right, in the previous year, is in India, and it has turnover or gross receipts greater than 50 crore in that previous year. So if the POEM in the current previous year is in India and in that year it has turnover or gross receipts greater than 50 crore, then even though the company is a foreign company, it will be treated as a resident. If these conditions are not satisfied, then the foreign company will be treated as non-resident. Indian company cannot be treated as a non-resident. It is always a resident in India. Place of effective management is basically a place where the key management and commercial decisions are in substance made. We have seen the provisions regarding residential status, and now we will see the provisions regarding scope of total income. And scope of total income is captured by section 5. So as we have learned, income tax is charged on the total income, which means the total amount of income referred under section 5 and which is computed in the manner laid down in the act. So section 5 becomes important. What does section 5 do? Section 5 outlines the scope of total income. That means what are the items of income which are within the scope of total income and what are the items of income which are outside the scope. Now the scope of total income depends on what? It depends on the residential status and the time and place of accrual or receipt of income. So depending on the time and place and also the residential status, section 5 enumerates the scope of total income. To understand this, let's look at this particular chart. So total income can either be Indian income or foreign income. So an income which is not Indian income can be said to be foreign income. What is Indian income? Indian income can be characterized based on its receipt or accrual, right? So if the income is received in India or it is deemed to be received in India, then it is an Indian income. Similarly, if the income accrues or arises in India or is deemed to accrue or arise in India, then on accrual basis it can be said to be Indian income. So both on receipt basis or accrual basis, if the nexus of the income is with India, that means either it is received in India or is deemed to be received in India, or it accrues or arises in India, or it is deemed to accrue or arise in India. In all these cases, the income is said to be Indian income. And the income which is not Indian income is said to be foreign income. Now, what is the scope of total income which is enumerated by section 5? Section 5 enumerates the scope of total income for different categories of residential status. So what is the income which is included in total income for a ROR, for RNOR, and for a non-resident? Let's see. Indian income. So Indian income is included in the total income of all the persons, whether ROR or RNOR or non-resident. Why? Because it has full nexus with India. So this is about Indian income. Income which is not Indian income is foreign income, right? Foreign income is taxable in the hands of a ROR, not in the hands of a RNOR or a non-resident. Why? Because it does not have a nexus with India, because it is foreign income. But it is taxable in the hands of a ROR, because by virtue of the residential status, a ROR has a strong nexus with India. And therefore, the global income of a ROR gets taxed in India. So the foreign income is not taxable in the hands of RNOR or a non-resident. However, there is an exception. What is the exception? Even though the income accrues or arises outside India, because it is foreign income, but it is still taxable in the hands of a RNOR. It is still taxable in the hands of a RNOR when such income is derived from a business which is controlled in or a profession which is set up in India. So even if the income accrues or arises outside India and therefore it is not Indian income but foreign income, but it has a part nexus with India or a part connection with India on account of being derived from a business controlled in India or a profession set up in India, it is taxable in the hands of a RNOR, but it is still not taxable in the hands of a non-resident. So what is the effect? As far as a ROR is concerned, resident and ordinarily resident, global income is taxable. That is whether Indian income or foreign income. So global income is taxable. In all the cases, the income is taxable in the hands of ROR. As far as a non-resident is concerned, only Indian income is taxable. Only Indian income is taxable. Foreign income is not taxable in the hands of a non-resident. As far as a RNOR is concerned, and mind you, RNOR classification can arise in the case of only an individual or HUF, not in the case of any other person. So in the case of RNOR, what is the taxability? Indian income is taxable. Indian income is taxable. Plus, even foreign income is taxable, but only that foreign income which is from a business controlled in or profession set up in India, even though it accrues or arises outside India. Now we will take a look at the concepts of income received or deemed to be received in India and income which accrues or arises or is deemed to accrue or arise in India. Income received or that which is deemed to be received in India is also treated as Indian income, and it forms part of scope of total income under section 5, and this is irrespective of the residential status or place of accrual. So even if the income accrues outside India but it is received in India, then it forms the part of the total income as per section 5 because it becomes Indian income. Now what is receipt? Receipt means the first receipt. Therefore, if income is received, say outside India, and subsequently it is remitted in India, one cannot say that subsequent remittance to India is actually a receipt in India, right? And therefore such income cannot be taxed on its remittance to India if it is otherwise not taxable in India. So receipt means the first receipt, not the subsequent remittance to India. Income which is deemed to be received. That means even if not actually received, it is deemed to be received in India, and therefore it comes within the scope of total income under section 5, and such items of income are enumerated under section 7. 1. This is something that we will discuss in detail in the video on salary income. Employer's contribution to RPF, that is recognized provident fund, which is in excess of 12% of salary, and interest credited in excess of 9.5% is deemed to be received in the previous year and accordingly taxed in the hands of the person. Employee's contribution in excess of 12% and interest credited in excess of 9.5% in the case of RPF. Number 2, if the balance in the unrecognized provident fund is transferred to a recognized provident fund, which is in the nature of employee's contribution and interest thereon, then that is also deemed to be received in the previous year. And thirdly, in the case of NPS, that means a pension scheme referred under section 80 CCD, we know that the contribution which is made by the central government or any other employer under section 80 CCD is also deemed to be received in the previous year and accordingly taxed. So it is first taxable under the head salaries, right, by virtue of section 7 because it is deemed to be received in the previous year, and thereafter a deduction from the gross total income is also allowed in terms of section 80 CCD. So these three items of incomes are enumerated in section 7. Income accruing in India or arising in India is also Indian income, and therefore it is taxable irrespective of the residential status of the person or place of receipt. So even if the income is received outside India but it accrues or arises in India, it gets taxable in India. An income accrues or arises when the person acquires the right to receive it, and it accrues at a place where the right to receive such income arises. Once the income has been included in the total income on the basis of being accrued or having been arisen or deemed to have accrued or arisen, then say if it is received in a later previous year, then it is not taxed again in that later previous year. For example, in previous year 1, the income accrues and therefore it becomes taxable in India. Then in previous year 2, it is actually received, right? So to avoid double taxation, since the income has already been taxed in previous year 1, it is not again taxed in previous year 2 merely on account of it having been received or having been deemed to be received in India in previous year 2. This is to avoid double taxation of the same income. Okay. There are certain incomes which are deemed to accrue or arise in India by virtue of section 9, and therefore these are also considered as Indian income and consequently taxable in India irrespective of the residential status of the person or the place of receipt. Even if the income arises in the hands of a resident or a non-resident, it's taxable in India. Even if it is received outside India, it's taxable in India if, as per section 9, it is deemed to accrue or arise in India. And there are 7 categories of items that are enumerated or listed in section 9. 7 categories of items, and we will deal with each of these items, right? The first item is income arising on account of business connection, property, asset, or source or a capital asset. Section 9(1)(I). So all incomes which arise directly or indirectly through or from any business connection in India. So if the income is arising on account of a business connection in India, or on account of any property or asset or source of income which is in India, or on account of a transfer of a capital asset which is situated in India, then such income is deemed to accrue or arise in India, and consequently it is taxable in India. So there are these 3 categories, and we will now briefly discuss each of these 3 categories. So first category is on account of business connection in India. So all incomes which accrue or arise directly or indirectly through or from any business connection in India is deemed to accrue or arise in India and is thus taxable in India. What is the meaning of business connection? Briefly, there, say, is a business which is carried on by a non-resident. A business which is carried on by a non-resident, and some activity in India. Some activity in India which contributes to the earning of the profits and gains from such business. And there is a relation between the two. There is a connection between the two. So that means one can say that such non-resident has a business connection. And since that activity is in India, the business connection can be said to be in India. And therefore, the income which arises out of such business connection is then deemed to accrue or arise in India. Now, it is not necessary that a non-resident should directly carry on a business in India all by himself. Okay. The business activity can be carried on even through an agent. That means through a person who is acting on behalf of the non-resident. Right? So business activity can be carried on through an agent also. Even in that case, business connection will be said to arise. And therefore, income arising out of from that activity carried on by the agent will be taxable in the hands of the non-resident in India. For this to happen, such person, that means the agent, should fulfill any of the following three criteria. And there are three criteria. The first criteria deals with the power to conclude contracts. Second deals with the maintenance of stock of goods or merchandise. And the third is in respect of securing orders. So we'll not go into the details, but very briefly, if any of these, one or two or three, are satisfied by the agent, then the non-resident can be said to have a business connection in India. Conclusion of contracts, for example, where the person has and habitually exercises an authority to conclude contracts. For example, where the agent has the authority to conclude contracts and he habitually exercises that authority, or he habitually concludes contracts, or he habitually plays the principal role leading to the conclusion of contracts, then, and there are certain other criteria to be fulfilled as well, then in such case, business connection is said to have arisen. Similarly, as per criteria 2, even if the person has no such authority to conclude contracts, as is referred to in item number 1, but he habitually maintains in India a stock of goods or merchandise. He habitually maintains a stock of goods or merchandise belonging to the non-resident, from which he regularly delivers such goods or merchandise on behalf of the non-resident, then the business connection will be said to have arisen in India. Similarly, where the person habitually secures orders in India, mainly or wholly for the non-resident or entities which are related to such non-resident, then also the non-resident will be said to be having a business connection in India. So if any of 1 or 2 or 3 criteria is satisfied, then the non-resident is said to be having a business connection in India, because there is an agent involved who is carrying out some activity for the non-resident. However, one should note that a non-resident may be carrying on business in India through an independent agent. Independent agent basically means a person who is dealing in an independent capacity, right? Who is dealing in an independent capacity. He is acting in the ordinary course of his business, and he is not mainly or wholly working on behalf of the non-resident. The agent may be working on behalf of many persons, including such non-residents, in which case it cannot be said that the agent is actually mainly or wholly working on behalf of the non-resident, and therefore the agent is basically an independent agent. If that be the case, then it cannot be said that a business connection arises, right? So business connection does not include any business activity carried out through a broker, general commission agent, or any other agent who is having an independent status. So either there is a business connection on account of the non-resident directly carrying on a business in India, or through an agent. There is a third situation also, where the non-resident has a significant economic presence, or SEP, in India. Then that SEP also shall constitute a business connection in India. So if the non-resident has a significant economic presence, which indicates a significant connection or a nexus in terms of economics with India, then the income arising out of that SEP will also get taxable in India in the hands of that non-resident. And there are two situations in which SEP can be said to arise, and we are not going to discuss this in detail. Once there is a business connection, what is the amount of income of that non-resident which gets taxable in India? Is it the entire income of such non-resident, the worldwide income or the global income? Of course not. The entire income of such non-resident is not taxable in India, but only so much of income which is attributable to the operations which are carried on by the non-resident in India are taxable in India, because that is the income which has a nexus with the operations carried on in India. So the attributable income is taxable in India. There are certain exclusions which are provided. In these cases, income is not deemed to accrue or arise in India, and therefore such income arising from these activities is not taxable in India. Number one deals with the category of export. So in the case of a non-resident, where the non-resident carries on certain operations in India, and those operations are limited or confined to what? To purchase of goods in India for the purpose of export. So the non-resident carries on operations in India, but those operations are only in the context of purchasing the goods in India and then exporting them, and no other activity is carried on in India. In that case, the non-resident is not taxable in India on account of income from such activity. There are three other categories on account of income from the business of running a news agency or of publishing. Number three, on account of activities relating to cinematography. Number four, on account of activities relating to the business of mining of diamonds. We are not discussing these in detail. So there are in all four exclusions which are provided, and in these cases the income is not deemed to accrue or arise in India. So this was about business connection. Next, as we saw, income which accrues or arises directly or indirectly through or from what? From any property or any asset or any source of income in India is deemed to accrue or arise in India and is thus taxable in India. For example, interest on fixed deposits in State Bank of India bank in Indore branch, which is in India. So the fixed deposits are in India, and therefore the income or the interest will be taxable in India. Similarly, if there is a house property in, say, Delhi, right? The rent is the income from such house property. Therefore, the property, asset or the source of income is in India, and therefore the rent will be taxable in India. Even if the rent is received outside India, it doesn't matter, since the accrual or arisal of that income is happening in India. Thirdly, on account of a capital asset situated in India. So all incomes which accrue or arise directly or indirectly through the transfer of a capital asset situated in India. So there is a capital asset, the capital asset is transferred, and therefore capital gains arise, and the capital asset is situated in India. Such income is deemed to accrue or arise in India and is thus taxable in India. Okay. Income from salaries is covered by section 9, 1, 2i and 3i. The following income from salaries is deemed to accrue or arise in India and is thus taxable in India. So as far as income under the head salaries is concerned, we need to see whether that income is payable for services rendered in India or services rendered outside India. If it is for services rendered in India, it will be deemed to accrue or arise in India, and therefore it is taxable in India irrespective of the residential status, because then it becomes Indian income. Okay. However, if the services are rendered outside India, it is taxable in India only in one case. In other cases, it is not taxable in India. So where the services are rendered outside India and the salaries are payable by the government to a citizen of India, then it is deemed to accrue or arise in India, and therefore it is taxable in India. However, in this case also, there is an exemption given by section 10(7), as per which any allowance or perquisite, right, any allowance or perquisite which is paid or allowed outside India, not in India, outside India, is exempt, right? So while the salary payable for service rendered outside India by the government to a citizen of India is taxable in India, but we also need to keep in mind the exemption given by section 10(7). Now we come to the next item of income, which is dividend, and this is section 9(1) IV 914. Dividend paid by an Indian company outside India is deemed to accrue or arise in India and is thus taxable in India. So dividend which is paid by an Indian company outside India is consequently taxable in India irrespective of the residential status. ROR, RNOR or NR, it is taxable in India. Dividend paid by an Indian company in India is of course taxable on receipt basis in the hands of all the persons. Dividend paid by a foreign company in India, it will also be taxable in India in all the cases on receipt basis. But dividend paid by a foreign company outside India, it will be taxable only in the hands of a ROR on global taxation basis, right? It will not be taxable in the hands of a RNOR or a non-resident, because it is not Indian income, it is a foreign income, because it is dividend paid by a foreign company outside India, right? So these are the implications. So what we need to note is dividend paid by an Indian company, even though it is paid outside India, but it is deemed to accrue or arise in India, and therefore it becomes taxable in the hands of all the persons irrespective of their residential status. Okay, now we will look at when is interest income deemed to accrue or arise in India and is therefore taxable in India irrespective of the residential status of the person who is receiving such income. And this is section 91V or 915. You may note that interest has been defined specifically, and this is section 228A. So there is a specific definition of interest, right? Now income by way of interest is deemed to accrue or arise in India and is thus taxable in India in the following cases. Interest is payable by whom? So in other words, who is the payer, or who has taken the debt or the loan, or who has borrowed the money. And when is it deemed to accrue or arise in India? That means in the hands of the payee, or the person who has given the debt or who has lent the money, right? So who is the payer? If the payer is the government, that means where interest is payable by the government, then interest is deemed to accrue or arise in India in all the cases, and there is no exception. So wherever we find in the question that the interest is payable by the government, then the interest will be taxable in the hands of the payee in all the cases irrespective of the residential status of the payee. Whether the payee is a resident or a non-resident, it doesn't matter. In the second case, where you find that the payer is a resident, that means the interest is payable by a resident. The resident has borrowed the money. Now the taxation of such interest income in the hands of the payee depends on how the resident payer is utilizing that money. So the interest income is deemed to accrue or arise in India in the hands of the payee and is therefore taxable in his hands in India. However, there are two cases. There are two cases where the interest income is not deemed to accrue or arise in India. What are those two cases? Where the payer, that means where the resident who has borrowed the money, he has used the money for the purposes of a business or profession carried on by him outside India, right? So where the debt has been incurred or monies has been borrowed and used for the purposes of a business or profession carried on by the payer, that means the resident payer outside India. In that case, income will not be deemed to accrue or arise in India in the hands of the payee. Or the second case, where the resident payer has used the money for the purposes of making or earning any income from any source outside India. Even in such case, the interest income will not be deemed to accrue or arise in India in the hands of the payee. Okay. Now we come to the Third situation, where the payer is a non-resident. That means the non-resident has borrowed the money and the non-resident borrower or the payer is paying the interest income to the payee. In that case, it is deemed to accrue or arise in India not by default, but only in one case. In all other cases, it is not deemed to accrue or arise in India in the hands of the payee. Only in one case, where the debt or the money borrowed is used for the purpose of a business or profession carried on by such non-resident payer in India. So only where the non-resident person who is paying the interest income, because he has taken the loan or borrowed the money and he has used that money for a business or profession carried on by him in India, only in that case the interest is deemed to accrue or arise in India in the hands of the payee, else it is not. Right? So use of debt or money for any non-business or professional purpose in India is not covered by the deeming provision. So clearly these factors are not relevant. Residential status of payee is not relevant. Residential status of payer is relevant. Okay. So whether the interest is payable by the resident or a non-resident or the government. Location and mode of incurrence of debt is not relevant. The purpose of debt is not relevant. The place and currency of receipt, etc., are not relevant. What is relevant? What is relevant is the residential status of the payer and the manner of utilization of debt or money. The manner of utilization of debt or money. Even this manner of utilization is not relevant where the payer is the government, because in that case, the interest income is deemed to accrue or arise in India in all the cases and there is no exception. We now come to the special incomes in the nature of royalty or FTS. FTS, fees for technical services. Royalty is covered by section 91 VI or 916 and FTS is covered by section 91 VII or 917. Right? First, let's look at what is royalty. So royalty has been specifically defined. Royalty has been specifically defined. And in a broad sense, it means what? It means consideration for the following, right? So if there is transfer of all or any rights, including grant of a license in respect of IPR. What is IPR? IPR is basically intellectual property rights. For example, patent, inventions, model, design, secret formula or process, or trademark, copyright, right? These kind of things are generally said to be in the nature of intellectual property rights or IPRs. So for example, if there is a patent and a person transfers the right to use the patent to another person, and in consideration of which he is made a payment of royalty, right, that will be covered under section 916. So transfer of the rights in respect of an IPR, and it includes grant of a license. Second, imparting of any information concerning IPR or know-how, right? So if there is a know-how which is possessed by a person and he transfers or imparts the information pertaining to that know-how to another person, in consideration of which he is paid an amount, that will be classified as royalty. Third, use or right to use IPR or certain equipment. So for example, if there is a complex or a heavy, for example, a robotic equipment, right, which is owned by a person, and he allows some other person to use that equipment for a charge, so that consideration will be classified as royalty. And lastly, rendering of services in connection with the above said activities. So this in brief, in broad sense, is the scope of the term royalty. Now, royalty excludes consideration taxable as capital gain, right? For example, if you transfer all the rights in respect of an IPR, in the sense that the IPR itself is transferred, right, as such, so there will be a transfer of capital assets which will give rise to capital gain. So where the consideration becomes taxable as capital gain, it will move out of the purview of royalty and it will be charged to tax as capital gain. If there is a computer software and the person uh, receives a consideration for the use or right to use such computer software, that is also treated as royalty. So if there is a computer software and the computer software is allowed to be used, or a license is given to use that computer software on account of which a consideration is paid, so that will also be treated as royalty. Now, what is FTS, or fees for technical services? FTS has also been defined. FTS has also been defined. And what does it mean? It means any consideration. It means any consideration, and this includes lump sum consideration as well. For what? For the rendering of services. There are three types of services. One, managerial service, technical service, or consultancy service. Right? Consideration for rendering of managerial, technical, or consultancy services is classified as fees for technical service, FTS, and it includes the provision of services of technical or other personnel. So if the services of, say, technical personnel are provided, that is also classified as FTS. FTS does not include two things. One, consideration for any construction, assembly, mining, or like project undertaken by the recipient. Second, consideration taxable under the head salaries is not taxable in the nature of FTS. So for example, a person is a manager or a consultant and he is employed with a company, and therefore he is rendering services as an employee. So that person will be receiving salary income, which will not be taxable as FTS, but it will be taxable under the head salaries, and consequently it will move out of the purview of FTS. Having discussed the meaning of the terms royalty and FTS, let's briefly see when is royalty or FTS deemed to accrue or arise in India. And let's look at the table, and this is similar to what we saw in the case of interest. Okay, what is relevant is who is paying the royalty or FTS. Royalty or FTS is payable by whom? The payer. And when is it deemed to accrue or arise in India in the hands of the payee? That means the person who is receiving this income. Let's see, and the rules are similar to that which are given for interest. So as we noted earlier, if the royalty or FTS is payable by the government, then royalty or FTS is deemed to accrue or arise in India in all cases, and it is taxable in the hands of the payee, and there is no exception. Second, if the royalty or FTS is payable by a resident, that means the resident is the payer, then the royalty or FTS is deemed to accrue or arise in India, and it is taxable in India. However, just like in the case of interest, there are two cases in which it is not deemed to accrue or arise in India, and therefore not taxable in the hands of the payee. Number one, where the right or property or information or services on account of which royalty or FTS is arising is used for business or profession carried on by the payer, the resident payer outside India. So where the right property information services are used, there is a business or profession carried on by the resident payer, and the use is in such business or profession carried on by the payer outside India. Or two, where the right property information services are used for the purpose of making or earning any income from any source outside India. So basically, where the usage is outside India, in a business or profession outside India, or for earning any income from any source outside India by the resident payer, then the income in the nature of royalty or FTS is not deemed to accrue or arise in India in the hands of the payee. Third, where the non-resident is making payment of royalty or FTS, then it is deemed to accrue or arise in India only in one case, where it is payable in respect of right property information services used when, and there are two situations. One, where it is used in the business or profession which is carried on by the non-resident payer, where in India, right? And this is similar to interest. This is similar to what we saw in the case of interest also. But there is an additional criteria as well. Or number 2, where the use is for the purpose of making or earning any income from any source in India, even then the royalty or FTS is taxable in the hands of the payee in India. Now this point is missing in the case of interest. In the case of interest, what we saw is that where the payer is the non-resident, then interest is deemed to accrue or arise in India only where the use is in business or profession carried on by the payer in India. Right? So while this is also present in the context of royalty or FTS, but even where there is no business or profession, but the non-resident payer is using the right property, information or services for making or earning any income from any source in India, then also the royalty or FTS is deemed to accrue or arise in India. So the factors which are not relevant and the factors which are relevant are similar to what we discussed in the context of interest. So factors which are relevant is basically the residential status of payer, whether the payer is the government or the resident or a non-resident, and how is the payer utilizing the right or the property or the information or services. This is what is relevant. Interest, royalty or FTS, it is included in the total income of a non-resident, right, where the non-resident is the payee. So it is included, it is deemed to accrue or arise in India. It is included in the total income of a non-resident irrespective of these factors. Whether or not the non-resident has a residence in India, whether or not he resides in India is not relevant. Whether he has a place of business in India is not relevant. Whether he has business connection in India is not relevant. Whether the non-resident has rendered services in India is also not relevant. Because the income is deemed to accrue or arise and therefore it's taxable in the hands of a non-resident in accordance with these special source rules. These are called source rules. And these special source rules exist for interest, royalty and FTS, which we have discussed. And taxation happens. So even though royalty or FTS is business income by nature, royalty or FTS is basically what? Its nature is in the nature of business income. And we saw that business income of a non-resident is taxable in India based on whether there is a business connection or not. However, when we talk about royalty or FTS, the special source rules which we just now discussed come into play. And therefore, whether a business connection is present or not, it doesn't matter. It doesn't matter because special source rules apply. And if the criteria of those special source rules are fulfilled, then the income becomes taxable in India because it is then deemed to accrue or arise in India. Lastly, gifts to non-residents is also deemed to accrue or arise in India and therefore it is taxable in the hands of a non-resident. And this is section 91VIII or 918. So if the income is arising outside India, why? Because it is in the nature of a sum of money, which is referred under section 56(2)(x). What is 56(2)(x)? We will study in detail when we talk about the chapter on income from other sources relating to gifts. Okay? There is a sum of money which is paid by a person resident in India to a non-resident or to a foreign company, right? So a resident is gifting a sum of money to a non-resident. Then it is deemed to accrue or arise in India and it is thus taxable in India by virtue of this particular provision. So this is something that we will talk about while we discuss the gift provisions in the chapter on income from other sources. So this brings us to the end of this video and hope things are clear to you. All the best to you. Good day.